A lot of people don't understand that. They say, well, why don't you just withdraw the money? That doesn't cost you anything. If you borrow money, they're going to charge you an interest rate. Why would you borrow your own money? I go, oh, bless your heart. You don't even understand how money works. So get ready. In this episode, you're going to see why borrowing using your IUL as collateral is way better. You'll come out way ahead than withdrawing your money. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for more than 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their authentic wealth. One of my favorite financial vehicles, without question, is a property structured max-funded IUL. It is the dream solution for many financial goals. It knocks the socks off of putting money in IRAs or 401ks. But it also serves as an emergency fund because, truth be known, banks and credit unions take your money and put 30 to 40% of it, that's called their Tier 1 assets, the 30 to 40% of their Tier 1 assets for liquidity and safety, and put it into insurance companies in BOLI, bank-owned life insurance. Sometimes, like 2008, they pay a measly 1% and they turn around and make 5% or more. How much more is 5 than 1? Don't say 4, it's 500% more, okay? You've got to understand that they understand how money works. They'll gladly pay you 1%. See, paying interest is not their foe, it's their friend. If they stop paying interest, they would wither up and die because they're going to make 5 times the cost of the funds. Would you hire an employee for 10 grand? That made you an extra 50 grand. Would you buy a widget machine for 10 grand that made you an extra 50 grand? That's called a 500% return on employment cost. It doesn't save you money to hurry and fire that employee that's making you 5 times what they're costing you. And yet you can't believe how many Americans don't understand what I just said. Okay. Same thing is true when you access money out of an IUL. Okay. And so let's keep this simple. I usually talk about when you access money, there's a sad way, smart way, and dumb way out of an IUL. The sad way is by dying. It's one heck of a return, but I don't recommend that one, okay? But people use it for living benefits. And if you put in money, like $500,000 into an IUL, and if it's netting 10% like our clients net, theoretically, you could pull out $50,000 a year, right? Well, if you did it the dumb way, you pull out $50,000 a year, and life insurance is one of the very few investments that's taxed FIFO, first in, first out, whereas annuities are taxed LIFO. Meaning if an annuity earned 10% and you started pulling out 50 grand a year, you'd have to pay tax on that 50,000 every single year because the last money you're earning is the first money coming out. See, life insurance is taxed FIFO, one of the very few investments that does that. So if I started pulling out 50,000 a year, it would take 10 years before I recovered my basis. Before I got back to 500,000 I put in there. The first money in is the first money out. That's called FIFO, okay? But if I kept withdrawing money, that would be dumb because now I have to pay tax on that 50,000 forever after, okay? That would be dumb. The IRS says you don't have to do that. Just borrow the equivalent of the interest you're earning, okay? So you use the cash value in your IUL as collateral rather than withdrawing it because you would be paying tax, unnecessary tax. So let's keep this simple. We call this a laser bank, okay? Liquid asset safely earning returns. That's a laser fund, which is a property structured max funded IUL. Many of my savvy business owning clients do the same thing I do. They keep working capital for business in an IUL. Real estate investors do this. I'll show you an example next. So if they have $1 million accumulated in their IUL, they could go withdraw that. But if they did, it's no longer their earning interest. So instead, they borrow from the insurance company using the cash value as collateral because the insurance company will loan them $1 million if they have $1 million sitting in there in the insurance company. They don't have to qualify for a loan with credit scores and everything like that. No. So they loan you $1 million. Now, there's 2 loans. One is called a zero cost or zero wash loan. You could borrow $1 million and the insurance company will charge 2%. So it's deemed a true loan because loan proceeds are tax-free. So that it's tax-free, they have to charge a nominal minimum statutory rate. So they can charge you, let's say 2%, 20 grand. But they will credit you 2% on the million they're using as collateral. So they credit you 20,000. They charge you 20, they credit you 20, didn't cost you anything. It's a zero zero net cost loan, okay? Now, you can use that kind of a loan if the economy is going crazy and it's going down, down, down. But most of my savvy clients, they use IUL and they use what is called the indexed or alternate or participating loan, okay? So the interest rate might be 4 or 5%. Let's use 5%. So they borrow from the insurance company. Did you hear how I said that? You're not really borrowing $1 million of your money. Your money is still in the insurance company. You're borrowing from the insurance company $1 million, leaving your million in there as collateral. Okay? Did you get that? Now, they say, okay, you can charge me 5%. Why? Because now they're not going to be credited 5% on the collateral. They're going to be credited the full index rate, which our clients average 10%. So the million that year is credited 100 grand. They get charged 50,000. So they made 100% more than the cost. They made a total of 5% tax-free on their money while they were using that money for whatever they wanted, okay? I don't know if you understand what I just said there, but it's 100% more money. Just like banks gladly pay their depositors 5% because they turn around and loan the money back on lines of credit or whatever at 10%, okay? They're making 100% more than the cost of the funds. So let me give you an actual example of this. I have a very savvy business client who his specialty, because he has a pool of clients who want to buy multiple residential apartment complexes or strip malls, commercial strip malls, okay? Now, he doesn't like to be the landlord. He likes to buy these multi-unit apartment complexes or strip malls from sellers who just want out, okay? So he buys distressed properties and then he turns around and fixes them up, invests $1 million or so, fixing them up, and then he turns around and flips them and makes 2 or 3 million, okay? It's just buying, fixing up, and flipping. Many people do that. And so he had, in 2017, a strip mall, I believe, is what he was doing this for. He was buying it for like 17 million. And he leverages, he doesn't use his money to do that. He needed $1 million for an earnest money agreement, and then he finances 100% like I do because he has good credit. So he called me up and said, Doug, I need $1 million to tie up this $17 million strip mall, fix it up and flip it up, because I'll fix it up. I'll buy it for 17 million, invest $1 million, and then turn around and sell it for 20 million. I'll make 2 million, okay, profit. I'll make $3 million, but I need $1 million to tie up to make 3 million, okay? That's called a 300% return, by the way. Now, folks, he called me up and said, send me that form. He means the one-sheet form where he puts his name and his policy number of his IUL policy. And then that sheet says, okay, do you want to withdraw $1 million? No. Why would he withdraw his money out of there? Oh, because it's not costing him? No, it would cost him dearly if he withdrew his money. Well, they're not charging him interest. Yeah, but it's no longer in there earning interest. It's costing money, okay? He understands this. Hopefully you'll understand it. So instead of a zero wash loan, he didn't borrow $1 million at 2%, and then they credited him 2% on that $1 million. He was feeling bullish about America in 2017. And so he borrowed the $1 million and said, charge me 5%, which is the higher rate. And so they charged him 5%. Now 5% on that $1 million is 50 grand. He doesn't have to write out a check for that. It's automatically deducted from what they credited him on that $1 million. Okay, that he left in his policy. Okay, that year he capped out at 25%. Okay, 25% on $1 million. He was credited 250,000, tax-free. Hello? He got credited 250 grand tax-free, minus the 50. He netted 20% return on his $1 million, 200 grand tax-free. On that $1 million, while he was technically using it to buy, fix up, and flip a strip mall to make $3 million. See, this is how money works. This is why borrowing money using your IUL as collateral. Now, could you go to a bank and use it as collateral? Yeah, but the insurance company will loan you the money, and they'll charge you rates that are lower than most banks. They'll charge you 4 or 5, and they'll keep crediting you, 10 or 12 or 15 or 25 or more, okay? We've had clients borrow money and get credited 61%, and they were only charged 5. See, this is what smart people do rather than withdrawing the money. So if you want to see examples of this, I would strongly recommend you study my book, The Laser Fund. This is 300 pages, jam-packed with information. It's 2 books in one. If you're a left brain learner and you learn more by the charts and graphs and explanations, you're a logical thinker, then you read this white one. This is about 200 pages, 14 chapters with all those charts and graphs. If you're a right brain learner, you learn more by stories and examples. You flip it over to this book. This book is about 100 pages, 12 chapters with 62 actual client stories of how a property structured max-funded IUL is the dream solution for all kinds of financial goals. It knocks the socks off of IRAs, of 401ks, 529 college savings plans, emergency funds, business working capital, real estate management, on and on and on, okay? Now, when you go in to laserfund.com or click on the link below, you contribute a nominal amount towards the shipping and handling. Sometimes people say, you said it was free. The book is free. I'll pay for the book. You can go on Amazon and buy it for $20 or $60 plus pay shipping and handling. If you do that, thank you. But if you go into Laser Fund and you contribute a nominal amount towards the shipping and handling, come on, put some skin in the game here. There ain't no such thing as free lunch everywhere. And you do that, I'll pay for the book. And I'll fire out a hard copy to you via priority mail. And when you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's formats there for your investment. But you can also schedule to attend one of our free educational webinars that we teach every week. No cost, no obligation. But you can even schedule an appointment with an IUL specialist to see how a property structured max funded IUL can work in your particular set of circumstances. And if you don't do that, if you think that any insurance agent knows what they're doing, you may end up with half or 20% of what your IUL could do because they didn't know what they were doing. It's crucial that your IUL is structured correctly and funded properly, and every year you have an annual review to rebalance it. You will end up with double, triple, or quadruple the result at the end of 10, 15, 20, 30 years than an IUL that's structured wrong. So make sure that you see one structured correctly in your particular set of circumstances, and I'll see you on the other side of your brighter future.